what are the safest, best ways for beginners to invest their money, starting from a very low risk. And also we'll focus on the products that help you against the inflation. So the safest option and the easiest option to invest your money is through bank deposits. So maybe there's an option to give money to your bank for a year or for 2 years, and they will pay you interest on that money. That's a good way, but the amount of interest is usually very low compared to inflation. It might be a good way to save money, but not really to save it from inflation or to multiply it in any way. The safest way, even safer than bank deposits, normally are government bonds, and you also don't need to know a lot in order for that investment to be not risky for you. You only need to know basically how they work, where to buy them. You can usually buy them online. They work in a way that you, instead of giving your money to the bank for a year or for 2 years, you give your money to the government. And they usually offer better interest rate on that money, and it is also more secure to invest in bonds than to keep your money in a bank. As we know, the banks are heavily leveraged. The governments also, but they have the ability to print the money through Federal Reserve. Of course, banks can use it too, but the connection between banks and Federal Reserve, like any national central bank, they usually work closer with the government than with the banking sector. Speaking of government bonds, there are also inflation-adjusted government bonds. So those bonds will pay you interest equal to the inflation. So if the inflation rate is rising in your country or inflation is already high, it might be a great way to invest into government bonds that are inflation adjusted. Another way to invest for beginners that is connected to more risky assets is through ETFs, so stock market indexes, for instance. Maybe you heard about indexes like S&P 500, that's from the USA, or DAX 40, that's from the Germany, for instance. So each country has its own index. And what is that? It's like one instrument, one thing that you can purchase that holds hundreds of different stocks. So for instance, S&P 500 from the USA, if you buy it, you will be an owner of 500 biggest companies in the USA. You will own a little bits of their stock. So that's how investing in index ETFs work. Those are quite risky because the price of the index can change dramatically. There can be stock market crashes, and in a few weeks you can lose, 50% of your money. But in the long term, and on average, you can multiply your money by 10% each year. So it's usually way above the inflation, and it's a real way to multiply your money. But of course, that comes with the great risk that is connected to the price fluctuations and of you panicking and selling of all of your investments at the worst time of panic. Another great way to invest is to actually look into your circle of competence. What do you know? What can be an advantage that you have that others don't? Maybe you know a lot about cars, or maybe about houses. Maybe you can buy companies via the stock market. You can buy stocks of companies that are from the automobile business, maybe Volkswagen, Stellantis Group, Tesla, or maybe you know what developers build the best houses. Maybe you have advantage there, or maybe you know a lot about business, about cosmetics, for instance, or beauty products, and maybe you can pick the best company from that sector. But of course, you will need a little bit of financial knowledge, how to read financial report, how to create financial indicators, etc. That knowledge will be crucial. Not only understanding the sector, the car companies or beauty sector, whatever, it's also understanding the financial report, because even if you find a great company, the stock price might be just super high and you will lose a lot of money, even though the product, the service, whatever was amazing. Summing up, the best and the easiest types of investment that you can consider are, of course, bank deposits and bonds, government bonds, not corporate bonds, not from companies because they're risky, but government bonds. Those are the two safest types of investments that are very easy to do. The other I talked about were connected to the stock market. They are much more difficult. They are connected to the understanding of financial reports, but also of the psychology of the markets. Then they have the risk of price volatility. So the price of your index, for instance, ETF index, can drop dramatically in a short term. So you have to be prepared for that. But those ways are great if you are looking to really multiply your money in the long term, to not only save, but to really invest and multiply.